In this video, we're going to look at a company's transactions and analyze them using the accounting equation for the second year of a company. You would want to follow this example because I'm going to show you how the second year's transactions are analyzed, and then I'm going to use this example to show you how to prepare the 4 financial statements for year 2. This is a continuation of the previous question that we did for ABC Company's Year 1 transactions. Let's read the question. It says, ABC Company's Year 2 transactions are presented below. They want you to show the effects of each transaction on the accounting equation, and then they want you to prepare the 4 financial statements for Year 2. And they've given you transactions A through F. Now, before we get started, this is the year 2 of a company, so it's an existing company that has already been in business for 1 year. I'm going to scroll up to the previous question that we did so you can see the transaction analysis we did for year 1. Then we prepared a balance sheet, and then we said that these dollar amounts were the dollar amounts at the end of year 1. So cash had a balance of $237,000, land had a balance of $60,000, and so on. That was at December 31st, year 1. Those would be the same balances that these accounts would have on January 1st, year 2. So when we are working on this year 2 example, our first line should have the beginning balances on January 1st, year 2. Which were the same balances that we ended up with for year 1 in the previous question. So I've already recorded them here. Cash $237,000, land $60,000, notes payable $200,000, common stock of $80,000, and retained earnings of $17,000. Before we get going, I just want to point out that I also have the totals running at the bottom here for each column, and then at the bottom here it's going to make sure that every transaction that I record keeps the accounting equation in balance. You don't need to worry about what's going on at the bottom as long as for each transaction that you record, you make sure that the accounting equation is kept in balance. All right, let's go ahead and analyze these transactions. Let's start with transaction A. Transaction A says ABC received $18,000 cash from issuing common stock. So let's go ahead and put A here. What happened? Remember, we are always a company, so we're looking at things from the perspective of the company. We received cash, $18,000. So our cash balance increases by $18,000. Now, that increases our assets, but then something else has to happen to keep our accounting equation in balance for that transaction. What else happened? Well, the company issued common stock. If the company issued common stock certificates, our common stock increased by $18,000. Assets increased by $18,000. Stockholders' equity increased by $18,000, keeping the accounting equation in balance. So now we can move on to the next transaction. Transaction B says ABC Company received $110,000 by operating a parking lot on land. So they have land that they bought last year and they operate a parking lot, and they received $110,000. So they were providing a service. We know that whenever a company provides a service or sells goods, we call that revenue. They just earned some revenue. So how would revenue affect this accounting equation? We know that revenue has the effect of increasing retained earnings. So I'm going to go to the retained earnings column, and we know that revenue increases retained earnings, so therefore I'm going to increase retained earnings by $110,000. Revenue increased by $110,000. Revenue has the effect of increasing retained earnings, therefore retained earnings increased by $110,000. But that's only one side of the accounting equation. What else happened? Well, if we earned revenue, we received cash. Therefore, my cash increased by $110,000. And that keeps the accounting equation in balance. Let's look at transaction C. C says ABC Company paid $93,000 for operating expenses such as salaries, utilities, maintenance, and interest. When the company paid $93,000, we know that our cash decreased, so I'm going to go to the cash column and put that our cash decreased by $93,000. I'll put that in as a negative number or parentheses that shows cash decreased. What else happened? Well, we know that our expenses increased by $93,000, but expenses has the effect of decreasing retained earnings. So therefore, we're going to go to retained earnings and decrease retained earnings by $93,000. Again, I want you to understand that the company's expenses increased. However, because expenses has the effect of decreasing retained earnings, we subtract $93,000 from retained earnings. Please practice that over and over again so that you are confident how revenues, expenses, and dividends affect retained earnings. Now for transaction C, our accounting equation is in balance. We can move to transaction D. Transaction D says ABC Company paid $11,000 cash dividends to its owners. Let's do the easy thing first. We know that they paid $11,000 cash, so our cash decreased. I'm going to subtract $11,000 from cash. What else happened? We know that dividends increased by $11,000, but dividends has the effect of decreasing retained earnings. So we're going to go to retained earnings and decrease retained earnings by $11,000. So for this transaction, the assets decreased by $11,000, stockholders' equity decreased by $11,000, keeping the accounting equation in balance. Let's look at transaction E. For transaction E, it says ABC Company sold land that has cost $60,000 for $60,000 cash. So what's happening here? We have land on our accounting books. Do you see here we have a column for land? Well, they're selling that land. For how much? For $60,000. So how does this transaction affect the accounting equation? We know that when the company sells land, our land is no more. Our land goes away. So we are going to decrease $60,000 from the land column. What else happened? Well, when we sell land, we got cash. How much cash? We got $60,000. So I'm going to put a positive $60,000 in the cash column. Our land decreased and cash increased. Note, for this transaction, the dollar amount of the accounting equation didn't change. There was no change in assets, no change in liabilities, and no change in stockholders' equity. The assets just got reclassified. One asset increased, the other asset decreased, keeping the accounting equation in balance. Finally, let's look at transaction F. It says we paid $150,000 cash to pay off a part of the loan from the creditor. So what's happening here? We have a loan. How much is the loan? The loan is $200,000. If you look at year one's transaction, we borrowed some money from a creditor and received $200,000 cash. And that debt is shown here. Now we're paying off some of that debt. We're not paying it all off, we're only paying $150,000. So let's see how this affects the accounting equation. Our cash decreases by $150,000 because we paid cash. Once we pay $150,000, we don't have a $200,000 debt anymore. We have $150,000 less. So I'm going to decrease our notes payable by $150,000 as well. That keeps the accounting equation in balance. Assets decreased by 150,000, liabilities decreased by 150,000, nothing happened to stockholders' equity. Now that we're done with all the transactions for the year, we can go ahead and prepare the 4 financial statements for year 2. The totals for each account that we have is already listed at the bottom here because I had a running total. And before we go and do the financial statements, I do want to make a note on our revenue and expenses. So actually I want to make a note on the retained earnings that this transaction C, actually it was transaction B, was for revenue. Transaction C was for our expenses. And transaction D was for dividends. This will help when I'm doing the financial statements. When you're doing your homework, there may be another column in your accounting equation that tells you to identify which ones are revenue, which ones are expenses, and which ones are dividends. So just read the McGraw-Hill instructions when you're doing your homework. Now that we're at the end of year 2, just note that these are balances of these accounts at the end of December 31st, year 2. These will become the beginning balances for January 1st, year 3. That's it for this video. I'm going to do the financial statements in the next video.